All right. Hello, everyone. I recognize some familiar faces that I've seen on other webinars. I've seen at events. I see some unfamiliar faces. I always like when I do any presentation to find out a bit more about the audience. So can I ask two people quickly? What you're looking for most today and a little bit about your startup, and then I'll see if I can hang some of the things that I say onto that. So at the top right of the screen is Abby. Abby, can I put you on the spot and ask you, what do you do? What would you love? No, you don't want to. Oh, you're welcome to. Not. All right, cool. Danielle Fox, hello. Are you up for telling us what's the key thing you'd love to learn today? Key problem, what you do, and then we'll see if we can work around that as a theme.
Sure. So I'm Danielle. I'm the founder and CEO of Over, which is a fertility and reproductive health startup wellness brand. And I guess from the session today, we're in the middle of our raise. So just more information about the marketplace right now, what you're seeing in terms of valuations, particularly with the news over the last sort of week with both SEIS on a positive front with EIS, but also what the investment landscape is looking at right now.
All right, very timely questions. Okay, great. And then right next to you, Catherine Parsons. Can I go to you? You're not muted, so let's go.
Hi, yes, I'm the founder of Screen Gold, which is an investment platform which allows the public to invest in film, television, and games. And like you, I'm a BBC alumni. My question is really about when you value your company, is it best to value it high? So, well, I'm concerned if you value it too high, it may be off-putting to investors because they may think that that you're asking for too much investment. But if it's too low, then it's not attractive in terms of revenue. So how do you gauge the valuation? I mean, I put into various calculators, so
yeah, probably ignore most of those calculators because they're based on fantasy inputs, but we'll get to that in a few minutes. Okay, so perfect question as well. All right, so I'm going to start right at the beginning. I know that my background briefing is that I think maybe like half of the people on the call are pre-first funding round and half might be over. So some things I might be skipping and tell you some things you already have covered, but I think it's worth starting right at the beginning. And I'm told that this is entirely data-driven, so I'm going to drop in as many data points as I can. I'm going to talk for maybe like 30 and a bit minutes, and then we've got plenty of time for Q&A afterwards. And you can ask me all the things that the Chancellor is not able to, and I probably can't do any better. All right, so let's start with the stuff that I know about. So a couple of founders get together, you meet up wherever it is, and you decide to start a company. And so we're going to start with the incorporation, and I'm going to turn screen share on periodically and then off again, so that it looks like I've got some slides prepared, but you can actually see the arm waving more easily. So I've called it the 10 most important things. I'm not sure it's exactly 10, but we'll keep going. So thing one is, when you incorporate, you typically start with 100 shares on Companies House, create ordinary shares split between the founders. At some point after that, you're going to want to do a share split. Don't be tempted to do things like sometimes you hear an accountant we've seen give really bad advice, like your company to be worth £1 million, you should start with £1 million of share capital. That just means you have to pay £1 million for your shares, which you probably don't have. So 100 ordinary shares typically split between the founders. Sometimes accountants also, it seems a lot of the bad advice comes from the accountants, is to say, create what I call alphabet shares, A ordinary, B ordinary, C ordinary. And we had one customer on SeedLegals who I saw this morning with exactly that. There were 3 founders, one's got A shares, one's got B shares, one's got C shares. And literally 100% of the time we see that, it needs to be undone before your next funding round. So why do people do it? I think there are two reasons. One is they think it gives more flexibility with different share classes, but it just makes things much more complicated, because whenever you want to do votes for increasing the number of shares and so on, normally you need majority votes, but it's majority by each share class. So now one founder can block everything. The other thing, the reason people do it is that they look at Mark Zuckerberg and his special super voting shares, and they go, I wish we could have super voting shares. But it's a bad thing to do, because what happens is investors, when they look at your company and they're looking to invest, they're looking for the least friction deal. And if everyone's got ordinary shares, but one company has got super voting shares where the founders want to take advantage over the investors, it's just a lot of friction that gets added. The other thing is, at the beginning, you've got 100% of the shares. You didn't need any more votes. It's after the third or fourth round, maybe it's an issue to address. So when you get to IPO for billions in value, make yourself special super voting shares at that point. But at the beginning, it really just adds friction. So that's everything about your getting your cap table right. So the next thing that you want to do, and here there's the screen share snippet, is allocate shares to team members. So as a early startup, of course, you've got shares, but you don't have money. So how are you going to get people to work for you? Well, the founders, of course, are working for no money and just equity. And then you get your first hire, which is usually the CTO, and the CTO might command £80,000 a year salary as on the open market, and you just don't have that money. So you want to give them some equity. And here there are a couple of important things to think about, one on the tax side and the other one just on how much. So on the tax side, let's start with the kind of easy one, which is if your shares have got no value, you can happily give shares to people. But as soon as they have a value, be super careful about giving shares to people unless they've paid for them. So investors pay for shares, they get shares. If you've got a consultant or an advisor who's not employed by the company and they insist on shares, sure, you can give them some shares with vesting, of course, we'll get to that. And if they've got a tax problem, it's their tax problem. But if it's an employee and you give the person shares, then it becomes an employee-related benefit and so on, and the company may be liable for the value of those shares to pay PAYE and NI and pension on, and the employee may have a big tax liability. So the rule of thumb is if the shares have no value, you can give shares to your CTO, you might give them 5% equity or whatever it might be, but once the shares have a value, then give share options instead. So the next question is, how many shares or options should you give? Your advisor might go, I'd like 5% equity for helping you find investors in your round. And is that a sensible number or is it an insane number? So it's very hard to work out when people just talk about 5%, 2%. So what I like to do is I like to equate it to pound value. So let's say you have an advisor, you'd like them as a board member in NED, they're going to spend a day a month working with the company. How much equity should you give them? So I reckon somewhere between £5,000 and £10,000 a year worth of equity might be reasonable for their day a month or something like that. Remembering that I always personally would prefer to hire a developer full-time than pay somebody who's going to breeze in the day a month. But if you really want that advisor or NED, let's say £5,000 or £10,000 a year. And if you figured that your company valuation early on is, let's say, £1 million right at the beginning, then £10,000 a year would be 1%. So you might give them 2% equity vesting over 2 years. So always in the same way that you don't give all of your team members, your employees, their entire annual salary on January the 1st. Likewise, if you have an advisor, you're not going to give them a big chunk of shares, because what if they do nothing? So you're going to give them some shares with vesting. So you might say 2%, which sounds attractive to them, vesting over 2 years, which is the equivalent of, £10,000 a year. 2% is still non-trivial. Often founders make a mistake, I think, in the early days of too lavishly giving away equity, because I've got 100% and I've got 90%. It's great, but we'll get to how that drops all the time. And after the third round, you're often wishing that you had a few percent more equity. So that is all about giving shares to the initial joiners or advisors before the first round. And once you get close to your first round, then you'll give share options typically instead, and always really to employees. The other thing, if you've got your CTO and you're going to pay them some money, but less than market, then you might use share options to make up the difference. So you might go, well, on the market, you would get 80K salary. Here, I can afford to pay you 40 for the first year, and then 60 afterwards, and then maybe 80 afterwards. So perhaps the difference that we need to make up is 40K in the first year and 20 in the second year, and that then might equate to maybe 5% equity vesting over, let's say, 3 years. So always think about it as you're giving equity to make up for the fact that you can't give cash, and then think about the amount of equity based on the valuation, which we're going to get to in a moment. So next slide we're going to get to, which is creating a share option pool. So what is a share option pool? I'm guessing many people on the call know about it, but there's often confusion. So a share option pool, the options aren't anything. They're just a reservation you make in your cap table to say, when I create an option pool, I'm going to price future shares that I issue as if these shares had been issued. So the effect of it is to dilute the existing shareholders. So an option pool on its own is nothing more than just a line entry in your cap table and some approvals. But the reason investors ask for it to be done in your first round or before the first round is when you create an option pool, it dilutes the existing shareholders. And the investors don't want to invest for 3% equity and then immediately get diluted to 2.7%. So they're going to say, please create a pre-money option pool, which is really just to avoid admin overhead. It's created as part of the round, so you don't need extra approval documents, but it's created essentially immediately before the round to dilute typically the founders. So now, being a data-driven call, what size option pool should you create? And on SeedLegals, the data suggests about half of companies create an option pool, maybe a little bit more, and it's typically 10%. In the US, investors, or if you have a US investor, which I think is becoming more common these days, in the US, it's often more like a 20% pool, but be careful not to create too large an option pool because you're just diluting yourselves. And don't let investors pressure you into creating too large a pool. Sometimes people go, I'll create the pool after the first round. But if you do that, then investors may well give you a hard time going, hey, if you want to create a pool, you should have made it before the round. Why are you diluting us now? And they may get antsy about it. They may understand. My take on what size option pool do you need is think about how many options do you want to give away between now and the next round, and create an option pool large enough for that, and you can extend it in the next round as needed. And you may well find that 10% is about the right amount. The one exception to that is if you're a single founder and you're now finding a co-founder, the co-founder you find, if it's right at the beginning of the company, you can give them shares. If the shares already have a value, maybe you want to give them options instead. And there, it might be giving them like 10 or 20% options because they really are late joining founder. Now, there's one thing that is less well known. If you have a late joining founder, it's a bit of an edge case, and you want to give them lots of options or lots of equity. The disadvantage of giving options is they have no voting rights until they exercise the options. And you want to maximize the voting rights that the founders have. So when it comes to any resolutions later on after your next few rounds, the founders are the majority voters and shareholders. So giving one of the founders options is great, but they have no votes until they exercise, and they'll have tax issues when they exercise. So they normally would only exercise when you sell the business or they leave the company. So you want to give them shares, but shares have tax issues. Is there a solution? And the solution is growth shares. So 60 seconds on this slightly less known thing called growth shares. What are growth shares? If I were to give you, let's say in my last round, I raised at a 5 million valuation. And let's say the price per share was £1 a share. So if I give you shares at nominal value for nothing, you're going to have a tax liability potentially of £1 per share. If I ask you to pay £1 a share, you have no tax liability, but you have to write me a check for hundreds of thousands of pounds, which is no good at all. It's zero value. But what you can do is you can create growth shares, and they say, I'm going to give you these shares, but when you sell them, the first £1 goes back to the company in value. So essentially, the shares are worth nothing today. They only have a value if the share price goes up. And because of that, it means there's no tax liability. And you have to agree a valuation. You don't do this with HMRC. You use a valuer to agree what the valuation might be. And if you get it right, there's no tax problem later. And if you get it wrong, there may be a tax problem. So it's a bit tricky. But anyway, you can drop me a note if you want any more info on growth shares, or you can just Google SeedLegals growth shares, and we've got an article. And it's sometimes the solution to this problem. So let me go back to my next screen, and we're getting on to valuations in a moment. So now's the time to talk about SEIS and the SEIS changes. So SEIS Advance Assurance, for those who are not aware, of course, is where you write to HMRC going, can we offer SEIS to our investors? And it's not legally required. You don't have to do it. The only legal bit on SEIS is after you've done your funding round, then you do your SEIS compliance, which gives your investors their certificates. And once upon a time, years ago, there were these edge cases where investors went, I don't know if this real estate or energy business can offer SEIS. So HMRC said, all right, you can write to us and we'll tell you. And that then became the fashion. And these days, it's sort of pretty much the standard that founders are expected to get advance assurance. Getting it is often the difference between the investor going, yes, I'm in, first get your advance assurance and come back later. So you can obviously easily do that on SeedLegals. We do about 40% of all of them now. If it's any more, we'll just ask HMRC to log into our platform and keep it simple. But these days, HMRC is very swift on that, and it gets done quite reliably. So my suggestion is it's useful to get your advance assurance. So now let's talk about the mini budget and the SEIS changes. And I wrote an article on that, which has got huge amounts of traction. So here's the 101 and what to do and what to be careful of doing before it's officially ratified by Parliament and so on. So the government has said that very nicely, starting in April next year, in companies, instead of raising 150,000 SEIS, can now raise 250,000 SEIS. And instead of needing less than £200,000 in gross assets, you can have up to £350,000. And instead of the company trading for 2 years, it can have been trading for 3 years. And on the investor side, investors can invest not £100,000 a year, but £200,000 a year and get SEIS. So I think this is fantastic. It's fantastic for a number of reasons. Obviously, you can raise more and investors can invest more. But I think the subtext as well is that in the past today, we sort of have a standard pattern of the 150K funding round. There's no hard and fast rule that said it needs to be 150K, but you go, I'll just do an SEIS round. You could have raised 250K with a mix of SEIS and EIS, but because everyone wants SEIS, or at least more people want, it's led to the 150K round. And because founders typically dilute 10 to 15% in an early round, that means first round valuations are maybe about £1 million. So the pattern today is raising 150K on $1 million valuation, which was fine when SEIS was introduced in 2012, but prices have gone up since then, and it's time things moved on. So I would love to see that move on rapidly to the 250K initial round at maybe 1.5 to 2 million valuation, and we'll see how that progresses. Now, these changes are nice, but they all start at the beginning of the next tax year. And so to be safe, or actually everyone was thinking you have to wait, but wait, you don't necessarily have to wait, because there's a trick, which is if you raise with a seed fast now, and the seed fast converts after April the 5th next year, which is exactly 6 months away from October the 6th, which is the maximum long stop date for SEIS in a seed fast, you can raise money literally now and issue shares next tax year and raise up to £250,000 starting now, so long as it all converts next year. And I think that's fantastic. And we've had a huge amount of interest on SeedLegals to do that. There are a couple of gotchas to know about. Of course, one, some companies are just starting off, and it's a great thing to do. Some of them have already raised SEIS. Can I raise more? And the answer is yes, you can. But if you've raised EIS, you can never raise SEIS afterwards. So if you've done a round with like raising 200K, mostly SEIS, a bit of EIS, you can't take advantage of it. The other thing is the shares have to be issued next tax year. So if you use Seed Fast to do this, just make sure you don't do a funding round between now and next year that causes everything to convert before then, or inadvertently you'd have given your investors their shares this tax year and they can't get as much SEIS. And there's one more gotcha, which is normally when the government announced something, you can sort of pretty reliably take it as it's going to be there the next day. But with this mini budget, it's by no means clear that the Chancellor or some of the budget features will be there. And although you can see the noise on the high tax rate cap and so on being removed, I haven't seen anything about the SEIS changes. But given the Chancellor and maybe more may not be around very long, I'd be slightly cautious and certainly mention to my investors, as I put in the disclaimer to the article, that it's subject. You can only reliably do this once HMRC have updated their website, which I think is when this goes through Parliament in November. In the meantime, I would suggest raising on this basis, explain it to your investors. And if you do want the money now and do want to sign a seed fast now, agree with your investors that you will offer them SEIS, provided that these rules come into play before the seed fast converts. And if they don't, then it'll be EIS. Or of course, you can wait longer. So you can drop us a note if you want to know more about that. But you know, it's the right balance between making a promise that may not be in your gift to keep, versus, of course, playing it super safe and waiting till later. So my goal is to give you the info and then make a decision. If it was me, I would raise SEIS, but explain to my investor, read the news, assuming that everything passes, we're good. If not, you know, there's a small risk it might be EIS. Okay, so now we are going to go on to valuations and the amount to raise, which is exactly in line with the questions earlier. So the first thing is picking a valuation. Now, at the time you go to raise investment, of course, you need to agree on a valuation with your investor, and that's because the amount of equity they get is a function of the amount you're raising and their investment and the valuation. So how are you going to pick a valuation? And you need to do two things. One, pick a number, and two, justify it to the investor. So what can you do? Well, you can read TechCrunch and then take a zero off the end, because those are insane American valuations. You can ask your accountant, who's going to say to you, are you making a profit? And you go, no. And they'll go, you're making revenue. You go, no. Are you losing money? Yes. And then they'll say, well, not only is your valuation zero, but I think you're not a going concern. So that's not going to work, because your accountant bases the valuation on past performance, and your investors are valuing it based on future potential. So going to the accountant isn't going to be any use. The next thing is to try and benchmark against your peers, which is always a great thing to do. You can try looking on sifted.eu or UK Tech News or others, and see what other companies have done. The problem there is often companies list the, you know, not so-and-so has raised $1 million, but no one says what the valuation is. So that doesn't help. So what we found is using data on SeedLegals over many funding rounds, over thousands of funding rounds, we've noticed that companies dilute or sell a median of 15% equity in a funding round. So this means that we see the rise of certain patterns, and essentially it means that the valuation of your company is simply 5 times the amount that you want to raise. So let's say you want to raise £200,000. If you were selling 15% roughly equity, you multiply the 200,000 by 5, that's £1 million. That's the pre-money valuation. After the round, the investors will own 200,000 out of 1.2 million, 16%, near enough 15%. So the one way of figuring out your valuation is just take the amount that I want to raise and multiply it by 5, which is genius, except that it doesn't really help because it just shifts the problem to how much to raise. So let's take a step back and look at how much you possibly want to raise, and then look at the funding patterns that we see in the market. And then you can use that information to benchmark yourself and also lead investors to the right position. And then we'll talk about what happens if you come up with too high or too low a number. So I think it always seems to go a bit like this. As a founder, you need to figure out how much you need to raise. And I think you always start with, we need 8 people. So I need like 2 developers, and then I need a marketing person, a data person, and a social media, and of course the 2 founders, and I need sales and a customer support or whatever. And to me, in all my startups, like the number is 8. And then you go, well, I need, let's say, £50,000 a year per person. So that's £400,000 a year. And I need at least 18 months. So that's 600,000. So I'm going to raise £600,000 because, you know, why do this whole fundraising thing twice? I may as well do it all in one go, and then I can move on for the next 18 months. But if you want to raise £600,000, that's like a 3 million pre-money valuation. And typically then you start going to investor meetings and they go, hey, the investors say, I love what you're doing. It's awesome. What's the valuation? You go 3 million, and they go, nice. And have you got revenue? And you go, oh, no. And you've got customers. Oh, no. What stage are you at? Well, we've got this here prototype. And then they go, love what you're doing. Come back later. And it becomes a story of your life. So really, if you think about time and the amount you want to raise, what you really want to do is you'd like to raise a big chunk immediately, and then you can get on with life. Unfortunately, for the investor, it's the opposite of what they want. They're delighted to invest large amounts when it's proven that what you're building is going to work. So if you think about Series A and backwards from there, so Series A round is when you've got traction, you've got revenue, and the revenue is growing month on month. And at this point, the investor can see all the challenges with a company, all the suspension of disbelief are dealt with. You can build a product, you can build a team, you've established product market fit, you figured out how to market and sell it. Your lifetime value is larger than your customer acquisition cost. So we're going to give you millions of pounds to give to Google and Facebook for massive marketing and pay per click and so on to grow faster. And that's the Series A. So Series A is when you've got revenue, growth, scaling, and so on. But of course you go, that's amazing, but I'm not there yet. So you go back a step, and that's really seed funding, which is you've got a product that's built, you've proved you can build it, you've proved that it's something roughly that people want. You don't yet have traction. So the seed investment is either to get you just to launch, or usually past launch, to get to scaling, to build the revenue model, and to get to Series A. But then you go, oh, I'm not quite there yet. I haven't built anything. And that's where angel investment comes in, which is angel investors are going to take a big risk early on, and they're going to take a big risk at a much lower valuation. And of course, they're going to get their SEIS or EIS to de-risk it. And that's where you're going to get the money to go and build things to get to the next step. So the classic path, I think, for a founder is something like this. Our data suggests founders put a median of £26,000 of their own money into the project before the first fundraising, because no one invests on a PowerPoint. You need to have built something. And then you may raise 50 or 70,000 pounds, friends and family, what we call the bootstrap round. And then you may raise 150 or 200, maybe now a bit more, in SEIS and EIS, in your classic SEIS angel round. And then you may raise 500,000-700,000 pounds in a seed round. And then you may raise some millions in a Series A later. And of course, you don't need to do all of these. You can skip some as you go along. But that seems to be more or less the journey. And I think the valuations that equate to that might be, we have an article on that, so it's going to be more accurate than I'll be now. But maybe when you are just have an idea, maybe 800,000 pounds. When you've built something and you're getting close to launch, maybe 1.5, 2 million pounds. These are a little bit up on the valuation numbers we were suggesting a couple of years ago, but prices have gone up since then. Your salaries have gone up. And then once you have traction, you may raise, a few £1 million Series A much later on. I've skipped the seed round stage, so you may raise 500,000 or 700,000 pounds, again, each time sort of diluting 15% or so. So now comes to the question of too high and too low valuations. So of course, too low valuation means you're giving away too much equity in the business. So if your investors, they always want more equity for their money. So they're always going to be putting, not always, some get with the program, they understand how it works. Some will try and lowball you, particularly VCs later on, and push to a lower valuation to get more equity. Sometimes it's just because they want more equity. Sometimes it's because as a VC, they often need a minimum amount of equity in the business because they know they're going to get diluted later and they still want a certain amount at the point you exit. So raised at too low a valuation and you're giving away more equity, and a few rounds later, you wish you raised at a higher valuation. Raise it to higher valuation, and you actually have generally a much more serious problem, which is that you've done a fantastic pitch. You showed people your blockchain, something is going to be awesome, and people have invested in your first round at a 10 million valuation based on your predictions of millions of pounds of revenue by year 2. Year 2 arrives and there's zero revenue because it took longer, no one's buying. You proudly show you've got 20K in revenue and you now are out of money and need to raise more. And guess what? It's a bit like you've opened the Schrodinger's cat box, shown that there's no life inside, and now you can't sustain that 10 million valuation anymore. And this is often a problem with crowd rounds because, they're relatively unsophisticated investors bought into the very nice pitch, and crowd rounds often get very nice high valuations. But I think particularly now in more difficult times, it comes to the next round and you have a tough call with your investors who nobody's investing at the same valuations because they've seen the data is showing you haven't delivered on the promise. And then your next round is at a lower valuation and you have a down round. So if you have a down round, if all the investors have got ordinary shares, which is typically for SEIS or EIS investors, there's no legal issue with that. You don't have to address it in any way or redress it. They just have sort of on paper lost money and they'll be unhappy, but there's nothing they can do about it. But if you raise typically from a VC and they got preference shares with anti-dilution rights, that means if your next round is at a lower valuation, you have to top them up with shares that come from you typically as the existing shareholder as if their last investment had been at the same lower valuation or somewhere in between, the different formulae. And this can be extremely expensive on you in terms of your own dilution. So be very careful if an investor asks for anti-dilution shares. Often a VC will always ask for it because that's what their rule book says, ask for pref shares with anti-dilution. But sometimes it's a cue from an investor that you're raising a too high a valuation and they're saying, all right, I'll go with your crazy valuation, but if your next round is lower, you're going to top me up afterwards. So So that's the 101 on fundraising. Now, I think if I go to Danielle's, you wanted more on marketplace, may get back to that. And I think, Catherine, we spoke about the valuation. And now I'm going to turn over to Q&A.
Questions. Okay, first question in the chat was from Sonali. She said, may I ask if the sharing of shares is valid for both PVT Ltd and LLC? I'm not sure what a PVT is.
So PVT is an Indian and Singapore company typically. So I mean, this info, of course, is really designed around UK. But the key things are we have Singapore SeedLegals in Singapore and Hong Kong, so you can do your fundraise on SeedLegals there. Most of the share issue things are the same. And the secret that most people don't know is you can actually even offer SEIS in a foreign company. You have to jump through some more hoops, but in general, the things I've said would apply to Singapore company and broadly to a US company as well.
Okay, question from Christina. Would I label the growth shares as growth shares on my cap table now?
Right, a good point. You can actually give them any name you want, but they need to be described in the company's articles. So growth shares have got a bit of overhead to do, because actually the articles say on a sale of the company, there's a section in the article which you might have read. It's always section article 5, liquidation, sale of assets, and it says on a sale of assets, the proceeds of sale are distributed in the following way. And what it has to say is that firstly, it pays out the non-growth shares people the £1 a share, and then it pays everyone, including the growth people, the remaining assets. So it needs to be in the article. So in order to issue growth shares, you normally would, it doesn't have to be, but it's often done as part of a funding round because you're updating the articles at the same time. So drop me a note directly on that, Anthony@seedlegals.com, and I can answer those ones directly.
Okay, and we have a live question from Holly. So Holly, go ahead, take yourself off mute.
Hi, I'm Holly Jade O'Leary. I'm Director of Alinea Customs. We have EIS Advanced Assurance, and we're currently raising our first seed funding round. We're revenue generating currently around 95,000 a year. And I would like to know whether there is any flexibility around the first commercial sale requirement for SEIS, because I've been told it's more attractive to investors. But in our first year, which our financial year ended the 31st of July 2020, was our research and development year, and we made a small amount of revenue in that year, even though we weren't trading.
Right, it's a great question. So everyone is aware, in order to offer SEIS, at the time the shares are issued, you have to have been trading for less than 2 years. And trading is defined as not only that you've got revenue, but the doors open for business. So HMRC has a definition that says, imagine you're a shop, you open the doors and now you're open for trading. And even if it's some time until somebody buys the first bit of cheese, you're still open for trading. So, and they're pretty inflexible, as in never change their minds on that. But where the flexibility is what is the trade? And usually these sort of edge cases, somebody sets up a company themselves to do their own web development, consulting or whatever, and bills some amount of money through it, and eventually goes, I'd like to do a startup and let me repurpose my company. Can we not count that? So there you have to make a case to HMRC on the facts. And I think there, Holly, your best bet is if you drop us a note, and the SEIS experts on our team, in particular Latina, can help you on what may be achievable there or not. So it's not to say you extending the 2 years, because that won't happen. It's redefining what is trading to go, that wasn't a trade, and this is a trade.
Yeah, thank you.
It might be useful too, you could grab a slot on office hours for Friday to follow up with the team quick. Okay, next question is from Chrissy. Chrissy, go ahead and take yourself off mute.
Yes, hello, and nice to see and meet you, Anthony. So there are a couple of questions. I had used a bit SeedLegals at the start, and I had one of the colleagues mentioning that one has to issue 1 million shares, and you mentioned 100. Is this now a problem, or it's whether it's 1 million, 100,000, or 100, not of that.
Okay, great point. So there's nothing special about 100. In fact, it's fine. In fact, when you do your first round, it's much better to have 1 million shares. But it all comes down to the number of shares multiplied by the price per share when you issue. So the normal pattern is you make 100 shares of a value of £1 each. So the founders collectively have to write a check to the company or wire money. All shares have to be paid for of, let's say, £100 between them. If you want to make 1 million shares, you would make 1 million shares of a nominal value of £0.0001 or whatever each. So it's still £100 in total. And that's even better. It saves doing a share split later. The reason I suggested often just doing 100 is in some cases on Companies House, you can't set a price per share of less than a penny. There's some user interface issues. And so you may just do 100 at a penny each, and then you can do a share split later. The thing to guard against is doing 1 million of them at £1 each, and then you literally need to pay £1 million or fix it with a consolidation, and it's a schlep.
Yes. And I have another question. So we developed our product, which is now used by one partner, but the market has moved, and we're still in the process of business development and trying to get customers on board. So we are not really having a regular MRR or revenue. So we are at the stage, yes, pre-revenue, but fully built product. It may require adjustments because market changes. What do you do then? Because having bootstrapped and paid a substantial amount for development, I wouldn't want to price it for 1 million because so how would you, because you talked about pricing and valuation depending on different stages, but it's not really reflecting our journey. So I was just
it's a great question. So you're saying that because of the amount you've invested yourself, you think the valuation should be substantially higher?
Yes.
Okay, so it's a super interesting conundrum, because on the one hand you've put a lot of money into it, and therefore in theory you'd like it to be worth more. On the flip side, from an investor, it doesn't really matter the path at which you got there. If the only way to get to that stage was by investing a large amounts of money, then truly it is that valuation. If it could have been achieved more efficiently at a lower cost, then they're going to discount that. But of course, there's no problem with companies raising much larger amounts at higher valuations early on. Often anything to do with med tech and health tech and so on are much more capex, and hardware businesses are much more capital intensive. So what you're looking for there is often a slightly different breed of investor that's happy with a longer term return. So many investors in SaaS businesses, they know that SaaS businesses can be built quite quickly at a fairly low cost to establish product market fit, and then can scale rapidly. And so fintechs and SaaS businesses are very attractive to investors. On the flip side, many hardware and health tech and so on might take 5 years before you can get your, FDA or whatever approval. And that needs patient capital, patient investors, and large amounts of investment. And of course, the rewards might be there, and there are fewer companies in that space, but you may need to hunt around to find that class of investor. So I think, just to wrap up that really interesting question, is I'd see it in two parts. One, if you demonstrate to the investor that this is a capital intensive business that will have a smaller set of competition and a bigger payoff as a result, and therefore the high valuation is justified, particularly since it took a lot of capital of your own to get there. then that's great. On the other hand, if the capital that you put in ended up being inefficient and you've rebuilt something 3 times and the investor goes, we could have got there with less, then they might discount that and go, anyone else starting at this point, I see this as the valuation. So you've got your work cut out to show the investor that it's the latter. And again, if you want to send me a pitch deck, I can give you quick thoughts on, on how to position that if possible.
I'm going to ask you quick questions from the chat, and then we'll go to Rania. Okay, first question from Evelina. When do the shares acquire value? Is it only as part of the funding, or how are they evaluated if the company generates profit and revenue and profit?
Excellent point. So there are a few things that might deem it to have value. One of them, of course, is after a funding round, you've just issued shares at, 2 million valuation. So clearly, by definition, they have value then. If business is bad, sometime later, they may have less value, but right after a round, they definitely have value, which also means right before a round, they also have value, because if they're worth £1 million tomorrow, yesterday, they couldn't have been worth 0. So really going back before a round, the question is how many months before does it move from sort of 0 to having value? And that's something you might want to raise with your accountant. And you might say, more than 3 months before the round, there's no problem. Less than 3 months before the round, it starts getting a bit more gray area. The other thing, of course, is not all companies raise investment. There are big companies that just sell stuff and are valuable by virtue of their revenue. So the company value may also be based on revenue. But of course, the one that can be most easily seen is the company's house filing that shows the last price per share paid. So it's mostly going to be, at least for most companies on this call, related to the time before your first round, because you're probably not doing much in revenue before then. But it's one to check with an accountant, your accountant. Yeah.
It's a good question. Okay, my last round was 150K in SEIS and 15K EIS. Is there anything that can be done to take advantage of the new rules?
Alas, no. Once you've issued EIS, you can just never change it. Of course, now that doesn't mean that many people are thinking creatively, pinging us at SeedLegals going, you see, if that EIS was SEIS under the new rule, then we'd still have SEIS available. But changing it becomes really, really messy, because all the shares have been issued and you couldn't have issued more SEIS shares on that day. So the only way you could have done it now is if that EIS, those EIS shares were not EIS. They couldn't have been SEIS because it was before the side of April next year. And they can't be EIS because that would prevent more SEIS. So if you can persuade that shareholder that I don't want my EIS and you haven't done the EIS compliance yet, then it just becomes a standard share, and you can have standard shares with no SEIS, and then you can keep going with SEIS. But so in the edge case, so we have one customer, for example, that raised £160,000, of which 150K was SEIS and 10K was EIS. It's like, well, that was great, but now in retrospect, I wish I hadn't done the 10K EIS. You've just screwed up my another 100K in SEIS. I wish I could have undone that. Well, if you've done your EIS compliance, there's definitely nothing you can do. If you haven't done that and you persuade that investor to take regular shares with no SEIS or EIS, then you potentially have your SEIS still available. But there's a gotcha there as well, which is we're getting down and technical here, which is if an investor or anyone has got shares that are not SEIS or EIS, they can never get EIS in the future. And the government's thinking there is, well, if an investor were to invest without any incentive, why should we use taxpayer money afterwards to incentivize them? So there's so were that investor to get their, in this case, 10K, you've persuaded them no EIS, they would never be able to get EIS in the future. So all in all, I think once you've taken EIS, it's kind of, I think you trying to reverse engineer that is more complicated than either is worth or is possible. And there's always just taking advantage of EIS from here on.
Okay, we'll try to get through 2 more questions. First up, Mirana. If I mispronounce your name, please let me know.
Miriana, that's fine. Hi, Anthony. Good to see you. And yeah, I have a question. We won many grants in our until today, and that also was counted, or some of them were counted towards SEIS, and then we have some left, but now we have because we are platform, deep data platform that has hardware, it's all packed up in the hardware components. So therefore, obviously we need much more money, as you earlier said, for developing the product before actually start raising, or rather getting some revenues, even though we have some traction already. And now we have a situation where obviously with this new HMRC agreement, or what they just announced, we will be having an additional 100K on SEIS. So we have an investor who's looking to put in much more, so on SEIS, and then part will be on EIS. Do we need to have different paperwork for that specific investor for 2 different rounds, or are there 2 different set of shares, or not? That's one question. And then I have one more, but that I already...
Let me answer the first one first, because then I'll forget by the time we get to the second one. Okay, so just so everyone understands, when you get grant funding, some, but not all grant funding counts as de minimis aid and is subtracted from your SEIS allowance. So have you checked, Mariana, that the funding you've got really is de minimis aid and is subtracted from your SEIS? The fact you're asking the question probably means you have. Is that correct?
Yes, yes.
Okay, great. So, and it's something you should always ask when you do get grant funding. Check with the person who's whoever you got the funding from, that really does count. So I would think that under the new rules, you would then have 100K of SEIS available, and so you can just do seed fasts for your investor now. You'd probably want to do a separate seed fast for the SEIS investment and the EIS, and they'll then convert, and the SeedLegals platform sorts all that for you. And the SEIS converts a day before the EIS, but you know, you can drop us a note and we can help you sort that. That's actually the easy bit.
Okay,
thank you. Second question I have for Friday, so we will speak on Friday. Thank you.
Okay.
Perfect, thank you. Okay, we're gonna get one last question. I can't, the name on Zoom is Zahid Carter. Oh, this is terrifying. Okay, please clarify for me.
It's Jin, so it's like
Jin. Okay.
Hi, Jin.
Hi. I'm really embarrassed to say this. I'm not embarrassed, but it's more like I have no idea what's happening in this session. I'm quite new to this. My brand is a swimwear brand, and I come from a design and development background. So all I've done at the moment is working on the marketing, the social media, and the product itself. I have no idea what all of these abbreviations are. I have already booked in a session, but I'm not sure if there's a capacity for another kind of lesson to just get the basic elements down.
All right, so thank you. And now I'm embarrassed because, you know, the question, of course, is where to pitch this. And it's easy for many people on the call. They probably just want the technicalities of the SEIS now or later. And others are going, dude, what are you talking about? It's a whole new world. So Purdy MA, maybe there's an excellent session to be had on, you know, people who are newer to the space. And secondly, either on the workshop or one-on-one with one of my SeedLegals colleagues. Delighted to sort of give you the 101 intro, but it might be really interesting for a session on without some of the assumptions. So yeah, we'll help you get there.
Yeah. We've got a bunch of useful blog articles and videos that you can watch as well. And then you can book a one-to-one in with and myself as well. We can kind of get you up to speed.
All right, and thank you. And by the way, of course, it's nothing to be embarrassed about, because it's easy to be in the bubble of, oh, this is how everything works. But of course, those in the know. And one of the things, my goal on the call is that when investors are looking to invest in your company or you, if you talk the talk and walk the walk and sound like an entrepreneur that knows their stuff, that makes you more investable. So, being part of this events, the space, coming to the Hotbed and so on events, being with the workshops, looking at all those articles on SeedLegals, on pitch decks, on valuations. And so when an investor says to you, what's your valuation? It's not fumbling around, and you can justify it. Or when they say, do I get drag along? And you don't go, I have no idea what you're talking about. You go, yes, 75% majority. Then they know that they can't, there's no BS involved. They know that you know what you're talking about. They're not going to take the mickey. And really, that makes you a lot more investable. So the key is not only to understand the mechanics of it, but actually kind of like talk the talk. And that is the key investability piece for an investor, because the challenge is an investor, until you have revenue, has no idea whether this is going to work or not. They have no idea, whatever it's medtech, swimwear, SaaS, you present an idea. How do we know it's going to take off or not? And so what they're looking for is little bits of signal in all the noise. So if I have just a moment more to talk about that, because that's really interesting. And once you have £100,000 a month in revenue that's growing, 10% month on month, it's an easy bet. It's proven. But when you go, I've got this cool idea, how's the investor going to know that they want to invest or not? So they're going to look at you, the way you present, how wonderfully you show the passion for it. Is the passion misguided, or is it backed up by user research and data? Do you know what you're talking about on funding rounds? And also they're going to start, doing some Googling. And if they see nothing and they see no web page, or when they Google it, the Google snippet says JavaScript not enabled or something, these are all signs that you're not there yet. But if you can write blog posts and articles and be a thought leader and pop up in their LinkedIn feed with all these articles you're posting, instead of going, I've never heard of you, suddenly they're going, you guys are everywhere. That's awesome. I mean, that was my secret when we started SeedLegals, and I still like to do it, try to be everywhere. And people go, you guys are everywhere. You must be going super fast. And then that's, there's more signal that they're going to latch onto. So and then you create the fear of missing out and the valuation and all the other pieces behind that. So maybe that's another session.
Wonderful. Thank you. And thank you for asking that question.
I was going to say, it looks like you've got a pretty supportive cohort here, if you look at the comments now.
Yeah.
All right.
Terrific. Let's all say a big thank you to Anthony. The SeedLegals office hour sessions are now already booked. We've got
a wait list of 7 founders as well. So we'll get in touch with the team, Anthony, and see whether we can get some more slots booked in, so that as many people as possible can.
And also, if you'd like to do a group session where you pick the things you might want, which is, content marketing, or, I'm new to the space or whatever, I'm delighted to do a session if that would help. And I see, by the way, one quick question, which is, what book would you recommend? My key book I recommend is The Mom Test, which you can get on Amazon for like £12 or something. And it's how to do user testing and who to ask and which questions to ask to determine if it's a vanity thing or people really want your product. So if you do want to sign me up for a session, I'm delighted to do that.
We'll definitely follow up on that. Perfect. Okay, everyone, wave goodbye to Anthony. Thanks so much.
Thanks all.
Stay along. We've got one more session to go.
Okay. Bye from me.
Thank you.